Hello, everyone, and welcome. Thank you for joining today's discussion on making the first accounting course a success with accounting education experts, Dr. Jim Stice and Dr. Kay Stice. My name is Virgil Ricks. I'm a director of product marketing here at Stukent, and I'll be hosting this today. And I'm excited to hear from the Stices. I'm sure all of you are as well. Before we jump into their presentation, I want to let you know that your mics and cameras are off for this webinar, but we encourage you to communicate using the chat on the right-hand side of the screen. You can go ahead and jump in there now and tell us where you're joining from and what the current weather is like where you're at. And you'll see Jim and Kay will probably be in that chat as well. They'll be joining us shortly. And we also have Abe from Stukent in the back who will be helping to answer questions and making sure that you're well taken care of while you're here. I also want to let you know that we are recording this webinar and we'll send that recording out to all the registrants after the event. And it looks like we have some awesome comments coming in, people from all over the country and world. We got North Carolina, we got Denver, Colorado, Indiana, San Diego. Looks like a variety of weather too. It's actually pretty nice here in Idaho. We're in Idaho Falls and we're having some warmer weather finally after a long winter, which I'm sure many of you have had a long winter as well. After Jim and Kay's presentation, we'll have a Q&A session. So be sure to put any questions you have for Jim or for Kay or for Stukent in the chat, and we'll be happy to answer those after their presentation. So enter those in the chat throughout the event. And then we'll also be sharing the presentation slides that Jim and Kay use, as well as an accounting assignment that they've put together for you to use in your classroom. We'll share those at the end of the event. So be sure to stay on until the end so you can get those. And then to kick things off, I'm excited to introduce Stukent's CEO and founder, Stuart Draper, who will share a few thoughts with us about Stukent and introduce you to Stukent. We'll go ahead and have him share that now.
Hi everyone. At Stukent, we're on a mission to help educators help students help the world. We create up-to-date, turnkey materials that save you time and make your job as an educator a little easier, and your students' jobs a lot more engaging. Our first-in-the-world Simternships, or simulated internships, give your students real-world practice with the concepts that you're teaching them. These powerful simulations work hand-in-hand with our courseware. Stukent courseware gives you great resources like detailed lesson plans and auto-graded chapter quizzes, while your students get an accessible, engaging digital text. But you know what? While these materials are ready to be released, our work on them is never really done. Stukent's slogan is "Stay Current." We update our courseware and Simternships annually to keep them current with what's happening in your industry. If there's something you think we can improve, let us know. Consider us your custom simulation and courseware provider. If we don't make it just the way you need it, we'll keep working on it to make it better. We're dedicated to bringing you the best simulations and courseware in the industry, and we're not going anywhere. Over the last decade, we've experienced explosive growth, and we now offer more than 40 Simternships and courseware bundles across 4 different categories: marketing, business, communications, and accounting. To date, we've helped nearly 1 million students at schools all over the world, and we can't wait to help you and your students next. Today, we're going to explore some great topics, ideas, tools, and strategies that can help enrich your curriculum, enhance learning, and keep you current with your industry. Throughout the event, feel free to chat in any questions you may have. The Stukent team will be standing by to help you. And if you enjoyed today's event, you can visit Stukent.com to get connected and see a schedule of our upcoming launches, fireside chats, presentations, and more. Each month, we host events just like this one, and we're building some great online communities for professors in the marketing, business, communications, and accounting spaces. We want to give you a place to meet new colleagues, collaborate on ideas, and share your professional insights and brilliance. So, thank you for joining us today. I hope today's event helps you, help your students, help the world. Enjoy the show.
Excellent. Well, as Stu pointed out, we are dedicated to bringing you the best simulations and courseware available. And that is why we've teamed up with Jim and Kay Stice for our accounting sim internships and courseware. And I'd like to invite them on the stage now to join us to give us their presentation on making the first accounting course a success and talk through some of the exciting things that they've also been doing with Stukent. So welcome, Jim and Kay.
Okay, I get to be here first. Is that it?
That's right. That's right. Number one.
It should be. Kay made it.
Hey guys, let's do a quick sound check. Jim, can you hear me?
I can't hear you.
I can hear you both. Sound great. Let's hear from the chat.
You don't look so good, but you sound great.
Yes. Let's get started. It's great to see all you folks. I see folks from South Carolina, from Kentucky. Jim's here in Utah. I didn't see anybody from California, probably a little early for those California people. So we're going to talk about
somebody. I saw somebody from Switzerland.
You did?
No,
we're honored. But I should have worn a nicer clothes.
Panama.
We're going to talk about the first accounting class here today. So here's what I want you to do in your minds. I want you to become a freshman or a sophomore in college. You're sitting before class in that very first accounting class. Your expectations are way down to the floor, below the floor. Maybe you took a bookkeeping class in high school and it was tedious and boring and lots of papers shuffling around. Or maybe you've seen the stereotypes on TV and in movies, except for Ben Affleck in the movie The Accountant, which is, we're not all commandos like he is. So your expectations are low. You're expecting the worst. And let's think about how to start that class. You could start that class by saying, well, let's go through the syllabus. Let's talk about all the quizzes we're going to do. Let's talk about the exams we're going to have and the homework you have to turn in. And as you do that, the students are sinking lower and lower in their seats. They're feeling oppressed and they're saying, yeah, this is about what I thought it was going to be. Or you could start that class by showing them right off the bat how interesting the world is when viewed through the accounting lens. So I've got 4 questions here. And we're going to read through them. But as you see them, by the way, no looking online, no peeking, no calling up their financial statements. If you wouldn't mind typing a quick answer into the chat, Jim, if you would monitor those answers. But first question. And remember, I'm talking to freshmen and sophomore in their first 15 seconds of their first accounting class. Hey, when Walmart sells you something for $100, how much did it cost Walmart to buy that thing from their supplier?
We're getting from Walmart. So 87, 50, 20, 43, 45.
Those are all good answers. It's 76. How do we know that? Accounting tells us that. We're going to see Walmart's income statement in just a moment. Anybody, you, me, anybody in the world can know that number. I'm not sure Walmart wants us to know that number, but we can know that number. And if we wanted to take a little extra time, we could say, well, what things are maybe higher than 76? What things are maybe lower than 76? How about this next one?
And we can also find out that it's been 76 for a very long time.
It's a very stable number. If Walmart sells you something for $100 after they pay everybody, their suppliers, their employees, for their advertising, their utilities, for interest on their loans, for their income taxes, after they pay all of that, how much are they left with in that $100? Anybody got an idea on that one?
We're looking at 8. We're looking at 5, 9, 10.
They wish.
Yeah, they do wish.
$2.5. And by the way, this has been going down relentlessly over the last 15 years, 30 years actually, as Walmart's got more into the grocery business, at least in the United States, and as they've been squeezed more by online sales, such as with Amazon. It's really been an interesting competitive development. How about this next one? If Walmart buys something, how many days until they sell it to you and me? Anybody got a thought on that one? How many days? You all know that ratio has a name, number of days sales and inventory, but the students don't need the name of the ratio. They got the idea. Walmart buys it, how long till they sell it?
45, 10,
45
27.
Is so perfect. That's a great number, 45. That's exactly right. As it says here on the slide, for Apple, the number's only 9 days. Both Walmart and Apple do something that's quite interesting. They don't buy things until, boom, they want them. Their suppliers build them in advance, make them in advance. And I once toured a warehouse for a Walmart supplier. I said, oh, this stuff is all Walmart's? They say, no, it's not Walmart's. We built it for Walmart. And at some point they'll buy it from us, but we're storing it from them now. Apple does the same thing with their suppliers. Isn't it interesting how accounting helps us understand the world a little bit better? And then this last one is my favorite one. If you go into a Walmart store and look around at the things on the shelves, how much of that has Walmart not yet paid for? Because we know they buy their stuff on credit. Well, this changes from year to year. Anybody have an idea?
67%, 75%. We're
How
looking
about
at
110%?
45%.
How about 110%? And again, this changes from year to year. This number is from the year 2020. Walmart was selling things to you and me that they had not yet paid for. In fact, they sold things last week that they haven't paid for yet. Walmart's whole operation is self-financing.
So what that means is their accounts payable is bigger than their inventory.
That's exactly right. But we don't need to tell the students that. All they need to know is, wow, Walmart hasn't even paid for the stuff that they're selling to me. And how do we know that? Accounting tells us this. Accounting gives us a window on the world. So in that first 15 seconds, what do you talk about in the first 15 seconds of the first day of that first accounting class? And that really can set the tone. Are you showing students how accounting helps us understand the world and how it really underlies all business? Or are you telling them about how many exams they're going to take and how many quizzes they're going to have to complete? We need to make accounting relevant, show relevance. The accounting system results in financial statements, which we then take to banks and investors to get money to operate our business. We use accounting to determine where scarce resources should be allocated. We use accounting to evaluate the performance of this store, this manager, this product. And in that first accounting class, my brother and I agree on this. You've got to use real world illustrations. Accounting is not company ABC. Accounting is Walmart and Google and United Airlines and Apple with their iPhones. Fill that first class with lots of real illustrations. And we're going to give you some examples right here, ladies and gentlemen, during this webinar. Now, if we have more time, if Virgil at Stu Kent would give us another hour, we talk about some teaching tips for that first accounting class, using in-class activities, connecting with your students, treating them respectfully with respect to grades. But Jim, I think we agree we don't have time for that today. But boy,
not today. No,
that'd be a fun topic for another webinar.
That would be.
We need to pause for just a second and thank Stu Kent and Stu himself, who you saw in the video just a moment ago. They have decided to jump with both feet into the accounting space. So they've got a financial accounting book, a managerial accounting book, a survey of accounting. They've created a simulation that you've got to see to believe. And a little bit later, my brother Jim is going to show you this simulation, all to help students see the relevance of accounting in the real world. So let's talk about that relevance. I'm sorry, Jim, I cut you off.
No, go.
Go. All right, let's try one. And
I'm sorry, go back.
I'm going back. Go.
I did want to, as we talk about relevance, I love this quote at the bottom of the screen, and I tell this to my students. When they focus on learning how to do accounting, I say, the person who knows how will always have a job, but the person who knows why will be their boss. It's not enough to know how to do something. You got to know why we're doing it. And that's to this issue of relevance. Students need to understand why understanding accounting is important to what they're going to do in their careers, whether they're accountants or not. It's important they know the why. Go ahead, Kay.
I say amen to that. So here's an example I use, again, probably 2 minutes into that first class, first session, first day, first accounting class. I say, imagine this room. Lily wants to start an ice cream company. It's always been her dream, and she's figured out to buy the equipment and the supplies and get the permits and everything. It's going to cost her $100 million. So where can this entrepreneur, Lily, get the money to turn her dream of an ice cream company into a reality? The $100 million. Now, well, she could, her personal savings, family and friends, door to door, in her neighborhood. I don't know about you, but if I were to do that, I think I'd come up with about 10,000, which is a little short of 100 million. So Lily's going to have to go to banks, private investors. If things are successful, maybe she goes public, and now she's getting investment capital from people all around the world. In short, in order to turn her dream into reality, Lily's going to have to get money from strangers, people that don't know anything about her. How can an entrepreneur get money from strangers, get strangers to loan her money, get strangers to invest in her company? How can she convince them? Well, those strangers are going to want to know about her finances. They're going to want to see what do you have, your resources, what are obligations do you have, and how much money does this whole thing make? Students sitting in their first class, they've never talked about accounting before, but they can understand this and say, here we are. We're the accountants. We're the ones that prepare this kind of information, that create this kind of information. We have names for them. The balance sheet is a list of your resources and obligations, but they already kind of understand that. If we just start giving them labels, balance sheet, income statement, they'll think, okay, I have to memorize things. But with the intuition, yeah, if I'm going to invest in a company, I want to know what they have. What are their existing obligations? I want to know how much they're going to make. That's an income statement. Let's take a look at Walmart's balance sheet. I'm a student. I've only been in class for 3 minutes now, and I'm looking at this balance sheet for Walmart. I like to use Walmart because even though it's a complex business to run, I mean, the logistics of running Walmart are incredible. It's an easy business to understand. You buy stuff from suppliers, you put them in your store, you sell them to customers. So do students know what cash is? Yeah, they know what cash is. Do they know what land is? Do they know what transportation equipment is? Trucks? Yeah, they know all those things. Now, Jim, I apologize for this because you've heard me say this a million times. I always say to my students, I am a little surprised by this balance sheet of Walmart. They've only got $14,000. I mean, they have over 10,000 stores worldwide. I thought they would need more than $14,000 in their bank account. Oh, wait, this is in millions. So it's $14 billion in cash and short-term investments. Okay, that makes sense. Students already can understand their first balance sheet. Now we might need to tell them what these things are down here. Long-term debt, everybody knows what that is. Accounts payable, I'm not sure what that label means. Hey, that's the amount that they owe their suppliers for things they bought on credit. Okay, I'm a student, I got it. I haven't read a textbook. I haven't done anything. I'm sitting 4 minutes into that first class. I understand that. Accrued liabilities, which sounds kind of scary. Hey, they've used electricity and haven't paid for it yet. That's an example of an accrued liability, and Walmart tells us about that stuff. We want to know how much they owe to their employees, to their utility company, to other sources. Here's their income statement. This is where we got that number, 76%. How about this membership? I asked students, what do they think that is? Well, that's Sam's Club. They know Walmart. They're saying, wow, the real business that I see every time I go to Walmart is reflected right here in their financial statements. I understand this income statement. Cost of sales? Yeah, that's the wholesale purchase cost of the things they sell to us at retail. I asked my students, what do they think these operating, selling, general administrative things are? Well, that's advertising. That's employee wages. That's rent. That's all those things. They understand this. Income taxes. Does Walmart pay income taxes? Well, there's their income taxes right there. Here's the bottom line. First semester, first class for these freshmen and sophomore, we're only 5 minutes into class and already they're understanding and they're thinking and they're actually in their heads doing a little financial statement analysis. Let's see, let's check that number. How much are they left with in profit from $100 of sales? Our students can understand these things because they've lived in the world. They can use their intuition to help them understand accounting, and they see how accounting matches up with the real world. So the question we started with, how can Lily convince strangers to give her $100 million? She can't without reliable financial statements. Financial statements allow entrepreneurs to turn their dreams into reality. Now my students are interested. Accounting is not just some reports that we file away in a filing cabinet somewhere or copy on files on a computer. These are reports that we take to people who are giving us loans, who are investing in our company. And without reliable financial statements, those strangers won't give us $100 million. They won't give us $1 million. They won't give us $10. They won't give us anything. Accounting and the financial statements that we create, we're talking about financial accounting here, it's one of the key pillars of modern society. Modern business could not operate without the financial statements we prepare. We are part of civilization, accountants are. The point to students, accounting and information is very useful to everybody. Here we're kind of focusing on attracting more students to the accounting major, but we're also making sure that everybody in our class realizes, well, accounting is important. Even if you're not an accountant, if you know about accounting information, you're a more valuable employee. You're a more informed person sitting at those strategy meetings and those decision meetings in a business. So let's look, Jim, with your permission, let's look at a couple of real world illustrations. There's a game. I left this part on the slide. This is Accounting 200. It's a little logo I use for my introductory accounting class. So this is an actual slide that I show my students. We play this game. I call it Name That Company. You'll be given details about a certain balance sheet item for a well-known company. Using your knowledge of the balance sheet, I do this about the end of the second week of that first class. Name that company. Let's play the game and see how we do. It's the company talking to us. I have $36.8 billion in receivables. That's 66% of my total assets. Who am I? Am I Google, Zions Bank, Home Depot, or Boeing? Let's see, Jim, tell me who's the first one to come up with the correct answer. What do we got out there?
Let's see here. Anessa says Boeing. Robert says Boeing.
Boeing does sell on credit. Airlines buy on credit for Boeing, and those airplanes serve as pretty good collateral. But that's not.
We've got Home Depot guess. We've got Google.
Notice that these receivables are 66% of total assets. Now, Boeing's receivables aren't 66% of their total assets. Home Depot's got a few receivables, primarily from business customers, but by far, Home Depot's biggest asset categories are their property, plant, and equipment, and their inventory. Google, well, if we had more time, we'd see Google's balance sheet.
Cash.
Cash is their
Cash.
It's Zions Bank or any bank. It's a bank, right? And I take this opportunity to tell my students, okay, let's think about banks. Most people think about, most normal people think that the biggest asset of a bank is their cash. But then we think about it. We have been studying accounting for 2 weeks now in this first accounting class. Cash, if I just take my cash into the bank and it sits there, how much profit is it going to generate? It's not going to generate anything. I take my money into the bank and then they lend it out to business customers. That's the primary asset of a bank, those receivables. They earn interest on those receivables. In fact, just this last week, I stumbled upon this slide. This shows the assets and liabilities in total of U.S. banks. Added them all up as of the beginning of this year. By far, the largest asset category are their loans and their leases, which are like loans. By far, by the way, their largest liability category are those deposits. And right now, my students are sitting in the class. We're at the end of the second week. They know about liabilities. They know about assets, and they say, okay, I now understand the banking business. How does it work? I take my cash into the bank. They loan it out to business customers and charge this much interest. And they pay me, the depositor, this low interest rate. They make money on the spread. It's an easy business to understand once you understand the balance sheet, which includes assets and liabilities. I guarantee the next time my students walk into a bank, they're going to walk in with a little bit of a swagger. They're going to say, I see what's going on here. You're charging 6, 7, 8% to those business loan customers, and you're paying me a piddly 2-3% on my deposits, and you're making money on the spread. Yeah, I got you. It's just balance sheet management. They now are empowered because they see the relevance and the informativeness of accounting in the real world. Let's do another one. One of my most important liabilities is for services for which people have paid me, but I haven't delivered yet. We call that unearned revenue often. Currently, that amount is 7.6%. Is that ExxonMobil? Do you pay them in advance for stuff? DuPont, Home Depot, United Airlines. Type in an answer. Who thinks they know this one?
United.
We're all united on United. It's 7.6 billion. That turns out, I just computed this the other day, that's 61 days. On average, people are paying United Airlines 61 days in advance for their flights. It's their second largest source of financing. Their long-term loans are their largest source of financing. But this float that they get from you and me, where they sit on our money for 61 days. They use that to pay their employees, to pay their operating expenses. It's a very large source of financing for United Airlines. Our students understand that they have to pay for the flight before they get to fly. And they've read about unearned revenue as they've studied the balance sheet. Now they say, okay, I myself am personally dealing with unearned revenue. I'm helping finance United Airlines operations to the tune of $7.6 billion. Let's try another one. Oh, I'm sorry. Students already know a lot about business and companies and financial statements because they've been alive in the world. All we need to do is give them the confidence so that they'll understand, yeah, I know what assets are. I know what an unearned revenue is. I've flown on an airplane before. You don't need a degree in accounting to understand this stuff. And it's nice to help students in that first accounting class see that accounting helps them, is a window on the world. I now know a little bit more about United Airlines. I know that they're living on the float 61 days I pay in advance. And that's not a trivial thing. That's an important part of the financing of their business. And now we understand that. And how do we understand that? Because we looked at their balance sheet and their income statement for that one.
And intuitively, they knew those unearned revenues they just never thought about it, and they didn't know it had a name. But when they look at the financials and think about it from an accounting point of view, they realize, there is a name to that, and it's quite a big number if I stop to think about it. But intuitively, they already knew that.
Yeah, well, to all of us, Jim, 7.6 billion is a lot of number, but a large number. But I know you're sitting on such a large pile of cash that 7.6 billion is not that much to you. It's pocket.
Nothing to it.
That's right.
That's right.
That's right. Okay. We get a little further along in the semester, and I tell my students, hey, take a look at this graph. By the way, all the illustrations that we're doing here and many, many more are available through Stukin. Jim and I have each been teaching accounting for about 35 years. So what we've done in our partnership with Stukin is we've sat down for each class day of an introductory financial class and an introductory managerial class, and we said, okay, what 5 or 6 or 7 little learning activities would I do during this class day? And we've written them up. We've written instructor notes so that somebody could take these examples that we're showing here, just take it right into the classroom. I think Virgil, when this session is done, is going to send you our instructor notes for these particular illustrations that we're using. But we got, I think, Jim, we said we got about 400 pages of these things. We've got lots of illustrations.
Quite a few. And it's not just charts like this. Here's the chart. Here's the question you would ask. And then you give students time to think about it. Here's their responses that they're going to come up with.
Yeah, that's right. I mean, again, since we've been doing this for 35 years, we finally just put our experience down on paper. So let's look at this chart. This is time series, over 20 years worth of data for Walmart on the top. We've got Apple right here. I'll put Walmart, Apple, Google, and Microsoft. Okay, great. There are lots of interesting things to talk about. Walmart as a retailer has the highest sales of any company in the history of the world. But what I want to talk about right here is Apple. And you look here, before 2007, Apple and Google were basically tracking each other. Their sales were about the same up through 2007. Then started in 2008, we see that Apple starts to differentiate itself and even more until now. Apple sales are not quite double, but they're almost double Google's. And we can explain that difference in those reported revenues in one word. Anybody know the word? In one word, we can explain why Apple just started shooting off in 2008. What happened in 2008?
Lots of iPhones.
iPhone is it. iPhone is it. Apple sales started to differentiate themselves in fiscal 2008. The first iPhone was sold in June 2007. Apple's fiscal year ended on September 2007, so they didn't have many sales. But in fiscal 2008, they started with the iPhone sales. As of today, I looked at their most recent annual report. In the notes of the financial statements, half of all Apple revenues are iPhone sales. Half. I mean, we think the iPhone, I've got one sitting right here, and I notice how small it is. My wife doesn't trust me with anything bigger than this right here. But this one device transformed that company, Apple, until now it's the most valuable company in the world. Let's look at that chart again. Before 2007, they were whatever. They were ordinary. After
They were a
2007,
computer company.
yeah, in fact, Jim, that's a good point. In January 2007, when Steve Jobs announced the iPhone, on that same exact day, I think it was January 9th, Apple changed its name to Apple. It used to be called Apple Computer. But on the day they introduced the iPhone, they changed the name to Apple. They're now a consumer device and everything else company, and it transformed them. And we can see that interesting transformation right here with just looking at some sales data and looking at the notes of their financial statements to see that half of their sales are now iPhone sales. I guarantee when I show this to my students, they say, okay, now I know a little bit more about Apple. I understand the world a little bit better than I used to. Let's do this goodwill computation. I love this. I'm a nerd. I'm a geek. I admit it. I love Star Wars. I mean, in a long ago in a galaxy far, far away, that just sends chills up and down my spine. Well, Disney purchased Lucasfilm back in 2012. Interesting transaction. And I wish I had more time to tell this story, but the purchase price, $4.1 billion, these are all billions, was negotiated by the finance people, the investment bankers, Lucasfilm and Disney. They agreed upon the $4.1 billion. But then the accountants for Disney had to say, okay, what did we just buy? Disney just bought. So they have to, anytime company A buys company B, you have to value the assets that you just bought. So the accountants for Disney said, okay, Lucasfilm, what do you got? I can imagine the Lucasfilm people said, hey, we got all kinds of stuff. We got sound equipment. We got these buildings. Yeah.
We got costumes.
Yeah, we got costume. We got lightsabers up the wazoo. And the Disney accountant said, yeah, to the closest 100 million, that stuff's worth zero. That's its fair value, zero. But you do have some liabilities of 0.8 billion. And so the accounts for Disney are saying, we just paid $4.1 billion for something that has identifiable assets worth zero, liabilities worth 0.8. So the business has a net equity of minus 0.8, and we paid $4.1 billion. Goodwill and other intangibles reported $4.9 billion. Why in the world did Disney pay $4.9 billion for a company that basically had negative net worth? Well, I can explain to one. What was Disney buying when they bought Lucasfilm? Relationships. That's a good way to think of goodwill. It's the value of relationships with nerds like me, and relationship with those actors and those toy manufacturers and those movie theater chains. All those relationships, Disney could have worked for years to develop them themselves, but they say it's cheaper to pay Lucasfilm $4.9 billion for relationships. Sure, I could teach my students how to compute goodwill in about week 8 or 9 of my class, maybe week 10. And I need to show them how to do that, but then I can motivate it by some real world illustrations. Jim, do I have time for one more?
One more.
One more. Perhaps my favorite. Facebook went public in 2012. Before 2012, and I'm old enough to remember this, we thought that Facebook, it was a private company. We thought that Facebook was one of these online hobby type things, not a business. In advance of the IPO in 2011, Mark Zuckerberg kept going around telling people, business people, we're a business. We're making money. We're $1 billion company. We are $1 billion company. Buh. He kept saying the word buh. We're $1 billion company. All right. But nobody knew because their financial statements were private information. Not known outside the company, but inside the company, they knew this. They knew the income statements for 2009 and 2010. Again, we're in the year 2011. They knew that 2009, they had made $229 million. 2010, they'd made $606 million. So Mark Zuckerberg was kind of extrapolating and saying, I think we can get to $1 billion by the time we go public, by the time that 2011 income statement is constructed. So I imagine this, I'm just imagining this, but I'll give you proof for this scenario in just a second. I can imagine it's midnight, December 31st, 2011. Mark Zuckerberg and the other big investors, the other interested parties in in a Facebook are gathered around a darkened room. It's midnight, waiting for the accountants to come in with that initial number. What was our income for 2011? And I can imagine, again, I don't know this is true, I can imagine them coming in and saying, Mr. Zuckerberg, great news. Our income in 2011 was up 60%. Now, all of us would be happy to have income up 60%. He said, yeah, that's great. What's the number? Well, it's 970 million. And he says, yeah, that's great. Go back to your accounting room there. And I know you've got estimates that you make, depreciation estimates, for example, depreciation lives on the computer equipment and other long-term assets that we have. I want you to look at those estimates one more time. And don't come back to this room until you've got a number that starts with 1 billion and something. Now, what makes me think that? Because here's the number that they eventually released that went public, and this is the number on which the Facebook IPO was based. Exactly 1 billion, ladies and gentlemen. I love the Facebook accountants. They said, okay, you want $1 billion? We'll give you exactly a billion. That doesn't happen by chance. Does accounting involve estimates? Does accounting involve judgments? Is there a little leeway in the reported numbers? Yeah. My students come into my class thinking that accountants are bean counters. Give us a pile of beans and we'll count them up. No, we're strategic people. We give information useful in understanding a business, but we also do our best to make that business look as good as possible. And I submit to you, ladies and gentlemen, Exhibit A, Facebook's IPO. Accounting numbers and real world applications make the topic come alive for our students. Now, will every student think, wow, this is interesting? No, but the students who have options, those students are thinking about finance, they're thinking about going over to the dark side and doing engineering or economics or whatever, they'll be intrigued. They'll say, this isn't bean counting, this is an integral part of business. If we use real world illustrations right from the first 15 seconds of that first class, the first day, we'll enliven those students. Now, speaking of a real world illustration, Jim, if you wouldn't mind, give us one. Show us one. Do I need to give you control? Oh, you took it.
I did take it. Take that.
Okay.
So what we've got here is I'm showing you, we created, Stu Kent came to us and said, we want to make a simulation. Stu Kent got their start by making simulations that were used in college courses. And they came to us and said, Kay and we want to make a simulation for accounting. And we have dealt with simulations in the past, paper-based sort of things, or using spreadsheets and such. And they showed us what they had done in other subjects. And we said, we want to do that in accounting. This is what we've always wanted to see. And so Stu Kent came up with, worked with us to decide what would a simulation look like. And let me do this, okay? Let me just show you. They came up with this simulation, and here's what we all as accounting instructors have always wanted. How can I teach my students the accounting cycle in a realistic business setting with videos and invoices and stuff? They'll learn the accounting cycle. They'll analyze transactions to see what the journal entry has to be. They'll take those journal entries, produce a balance sheet and an income statement. And then here's the thing that I probably like the most. Once they prepared these financial statements, what are we going to do with them? As Kay illustrated at the very start, we use financial statements for reasons to evaluate performance, to get interested financing. So the objective here is we're going to prepare and analyze financial statements because we want to expand this business. We want to go to a bank. So the eventual purpose is we want to use these financial statements to go to a bank. And you'll see here, we've got 11 rounds. We start the business, we run the business for a week or two, we run the business, Then we'll make adjusting entries. Then we'll run the business for another month. Then we'll make adjusting entries. Then we'll run the business, make adjusting entries. We all know that one of the hardest parts about the accounting cycles is adjusting entries. So we're going to have students do 3 sets of adjusting entries. Then at the end of the quarter, we're going to prepare financial statements, and then we're going to evaluate the financial statements. Now, what does this look like? Let me share with you an example of a typical round. We have video, and I'm going to switch over to the actual video here. I'm going to go to round 1, or let's just go to round 3. You're not going to be able to hear this because I'm running it off my computer. But we have our business partner show up, gives us instructions on what we're going to do. Now, you can't hear what they're saying, but this business partner shows up at the start of each round and says, here's where we are in the business, and here's what I need you to do next. We've got tasks down here, and there are resources. So then we go to the inbox, and we see we've received all these emails. Here, for example, we made a rental. We rented some space. Here's the invoice for it. We're going to use this to make journal entries, and we're going to use it to make adjusting entries. We're going to prepay this rent for 3 months, record it as prepaid rent. Then every month, we're going to have to go in and make an adjusting entry. So there's an example. We're going to make business decisions. What logo, what's our location going to be? We get all of these emails from our business partner, and then our challenge is to go in and make journal entries. I'll just show you this quickly. We're going to generate
Jim, just a quick point. The thing that I think is awesome about this, and we've all lived through working from home, this is exactly a simulation of what it would be like to be a bookkeeper and small business owner working from home, getting emails from suppliers, getting a video message from your business partner, and then responding to that all in an online environment. So this is as realistic as you can get. This is like being an accountant for your own business working from home.
Yeah, you get emails and you respond. So here are our emails that we get. This one, hey, we're open for business. We're going to get a sales report. Tells us exactly what to do with the sales report. We'll go out, click on this sales report generator, and it generates a sales report. Then we're told down here in the journal entries, here's the journal entries I need you to make. Okay. So a student goes to the journal entry hub and they make journal entries. This one is for tracking our cost of goods sold from the sales report. These numbers come from the sales report that we generated. You'll notice we have a debit of cost of goods sold of 1,602, a credit to inventory. Now, let me show you something here. Notice that these are the same. If you're a purist, this inventory should be indented. Debit, credits are indented. But what we found is if you look at the accounting software out there, like QuickBooks, this is how they do it. They don't indent the account. So to simulate the real world, we elected to do it like the real world does it. We have columns for debits and credits here, but it's not here. I had to get used to that. I must admit, I had to get used to that because I'm a purist. I think the account title should be indented, but it's not. In the real world, it's not. In addition, in the real world, you can do your credits first if you want to. So this software allows it to do that. They make this journal entry. We give them feedback. You know, this is why the journal entry is how it is. So they'll be able to if they have questions, they get this feedback on why was this the debit? Why was this the credit? They're also able to say, oh, I've done a journal entry like this before. They can go back and review the journal entries they've made in past weeks.
Jim, just a quick word about that feedback. So
Please.
The feedback is primarily written by the guy who's talking to you right now, Jim. And the nice thing is, this is feedback from somebody who's heard this, who's talked to students 100,000 times who have made exactly the same mistake. So he's not inventing any new words here. He's told this to students.
Yeah.
That's one of the benefits. You could look at my brother, you can see how old he is. That's part of the benefit of working with somebody so old. They've talked with students about these same issues. They know what he knows what they're gonna ask, and he's provided the feedback that will help them understand, because it's the same thing he's been telling his students for years.
All I did on that feedback was write down exactly how I would say it to us, exactly how I've said it 1,000 times to students.
Yeah.
Move to the adjusting entries part. So at the month end, we tell them, first of all, here's your trial balance. Before adjustments, here's your trial balance. You can download this and look at it. Then we've got more emails from this week. Here's the email on the month end notes. We tell them, you're going to have to make an adjustment for office supplies. We bought 500, there's 150 left. We talk to them about depreciation. We explain to them, just in case they haven't hit accumulated depreciation in their class yet, we're going to use the account accumulated depreciation right here. And we also say this is the first month, end of the first month. We're making our adjusting entries on a monthly basis and preparing financial statements on a quarterly basis. In real life, we do adjustments and financial statements at the same time, but the objective of this simulation is to practice making adjusting entries. So we're going to do adjusting entries monthly, prepare financial statements quarterly. So we try to simulate the real world as much as possible, but when there are teaching points we want to make, we'll deviate, but we'll tell them about that. So I'm going to make an adjusting entry here. Just give you an example. This is I'm going to make an adjusting entry for insurance expense. So in the first account, I'm going to identify, I'm going to make an adjusting entry for insurance expense. It says, okay, what accounts do you want to use? And I say, well, I can't remember, how much did I pay for rent? Or I'm sorry, how much did I pay for insurance? I click at the bottom of the screen, there's this resource tab. And when I click on that, up pops my insurance contract. And just like in real life, every expenditure we make has an invoice attached to it or a bill attached to it. Here I can see, I've got insurance for $1,000 a month. So I go back to my journal entry, debit my insurance expense for $1,000, credit prepaid insurance. When I'm comfortable, I hit that validate button. You'll see it says 0 out of 5. I get 5 cracks at it. The first one is graded, but if I don't get it right, I get another chance, I get another chance, I get up to 5 chances. If I miss it 5 times in a row, the software is just going to say, here's the answer. Here's what you need to do. And
That's called mercy at that point, mercy.
Mercy. And then we show them the feedback.
So there was a question, Jim, there was a question asked in the chat, how is this graded? Well, this is exactly how it's graded. Each little piece, the student is graded on their response, and they get full points if they get it right the first time. And I think the second time they get a reduced number of points, and then after that, 0. And the first few rounds are weighted very low, just to give students a chance to practice. And then the later rounds have more points assigned to them.
Our objective here is not to differentiate between, okay, who's the best at journal entries? That's what exams and quizzes are for. Our objective with the simulation is to get everybody up to a minimum level of competence. So the first 5 rounds are weighted a lot less than the last 5 rounds. They practice on the first 5 rounds so that by the time they get to the last 5 rounds, they're pretty good at it. And at the end of the simulation, they're good at journal entries, they're good at adjusting entries, they're good at closing entries, they're good at making financial statements. That makes the rest of the class a lot more comfortable. I've had students come to me at the end of the 10th week and say, explain to me these journal entries.
What's this debit and credit stuff that we see all the time?
Come from? Are we going to have to know that on the exam? This simulation makes sure that everybody understands debits and credits. Everybody understands assets, liabilities, and equities. Everybody understands adjusting entries. We're not trying to differentiate students with the simulation. We're trying to get everybody up to the same level of competence.
Think of this simulation as something that your students are doing as a project off to the side during week, say 3, 4, 5, and maybe 6 of the class where they're learning, and you're talking about in class the accounting cycle, journal entries, and then adjusting entries and closing entries. While they're studying that in class, they've got this little project, this little simulation going off on the side to hammer away to make sure by the end of week 6, the debits and credit language is comfortable to them, so they can go through the rest of the class and account for bad debts and depreciation, the rest with comfort on the debit and credit language.
Yeah, when we turn our attention to bad debts, we don't have to worry about debits and credits. They get that after this simulation. I think it's round 10, we get to the financial statements, and we have an exercise here. You can see on the screen, it's just a drag and drop exercise where we ask them, which of these accounts, and this is just our chart of accounts, which of these accounts goes on the income statement? Specifically, which one goes in the revenue column? Which one goes in the expense column? And they'll drag them over there. And if it's right, it'll light up green. And if it's wrong, it'll light up red, and they'll try again.
This is so fun to do that we're in talks, even as we speak, with Milton Bradley to try to turn this into some kind of board game. It's really fun, this drag and drop thing that Stu Kent.
And they light up when you get them there. When you've got them all filled up, you hit a button that says generate an income statement, and the numbers from your trial balance, your adjusted trial balance, appear in the income statement like magic. Then you go through an exercise of doing closing entries. Now that you've made the income statement, now that you've done closing entries, drag and drop to the balance sheet. So you take all the accounts from your chart of accounts, and you need to know which one's going current assets, which one going current liabilities. Where do they go? Once you've done that drag and drop exercise, your financial statements, once again, your balance sheet appears. And again, the hard part is not the addition and subtraction. The hard part is knowing what is property, plant, and equipment. Where does it go? What goes on the income statement? What goes on the balance sheet? This exercise drives home that point. Accounts only show up one place, and you got to know which ones are income statement, which ones are balance sheet, and which ones are assets, liabilities, that sort of thing. Then, once they finish that exercise, we introduce them just to a couple of ratios, And we explain the intuition to this. We send them an email saying, need you to calculate a couple of ratios. And in that email, we say, here's what a current ratio is. Here's how you calculate it. And here is what it means. Here's why a bank would find it useful. We do the same thing for debt ratio. We do the same thing for return on equity ratio. And then we send them an email saying, here are the industry averages for our industry. And they have to make an assessment. Once they've done the calculation, then they compare our company's current ratio to the industry and say, is it below average, average, or above average? So they're making this analysis in anticipation of how is this going to look to a bank. Once they've done this exercise, they get an email in their inbox from the bank saying, hey, we received your analysis. We received your financial statements. We received your analysis, and congratulations. Your company's doing well. You're approved for a loan. It turns out at the end of this, everybody's approved for a loan. There are different possible. We have 6 different scenarios so that not every student is using the same scenario, but every scenario results in the business is profitable, and a bank is going to approve your loan. But we walk them through the accounting cycle, do a little bit of analysis, and show them this is why financial institutions use these financial statements. So that's our simulation. Throughout it, if a student needs help, they click on the help button at the top, and we've prepared little videos. If they need to remember, what do I need to remember about adjusting entries? We provide them, 3 or 4 minute videos to just give them a brief refresher of what goes into a journal entry.
Where did Stu Kent get the budget to hire Tom Cruise to do these help videos?
It's amazing what they pulled out all this. They pulled out all the stops on this one. The point is this: if students need help, we've got help for them. So we've prepared this simternship. We're preparing others as well, financial statement analysis and some managerial accounting as well. But here's the point: real world. We want them to be exposed to real world. Okay, take this.
So remember, first 15 seconds of the first day of that first class for these poor quivering freshmen and sophomores who are scared and think the worst about accounting, you're going to show them that accounting is relevant, that it relates to allocating resources, scarce resources in an economy, that helps businesses evaluate their performance and the performance of their managers. And we show students that they already understand how accounting impacts the real world because we use real companies that they already understand. Grabbing the attention of students in that first accounting class, Jim and I think that that is an amazing way to attract the students who might otherwise take their options and go somewhere else, go to finance or go to economics, show them that accounting is interesting and relevant, and then we've got a better chance at getting them to be accounting majors.
So Virgil, we'll turn it back to you.
Excellent. Well, thank you so much. It's been very informative. I know there was a lot of questions that came in the chat, and you were both very active in the chat answering those. If there's any other questions that we have for Jim K, you can put those in now, but we'll go ahead and pop up a link where you can request access, free instructor access to both the courseware and the Simternships. You'll see that pop up on the bottom left-hand corner there. And so the Simternship is what Jim just talked about, which is that simulated internship experience. And then the courseware is your kind of your more traditional digital textbook, but it also has all your lecture slides and your quizzes and your assignments and a lot of those videos, hundreds of videos that Jim and Kay have done to help instruct students on these financial accounting topics. And so you can click on that, learn a little more, request free instructor access there.
Let me just insert this, Virgil. This simulation, I get kind of excited talking about it because it's what I wish I always had. And it was nice for Kay and I to be involved in creating what we always wish we always had. So it's pretty impressive. I'm quite impressed with what Stu Kent has done here.
Yeah, we've had a lot of great feedback on it, and it's been a lot of fun working with Jim and Kay to bring this together. We'll also share the slides that Jim and Kay presented, as well as an assignment that they've put together for you that you can use in your class, and that'll be shared near the chat in the right-hand side of the screen there under the handouts. So
Virgil, just a quick note, yes. That assignment that you're distributing, that's just a small sample of the type of instructor notes we have created for every class day for financial and managerial accounting. So that's just a sample.
And there was a question about how often those notes are updated. If you want to speak to that.
Always. I mean, I don't have anything else to do. That's what I do. I update those notes. Stu Kent forces us to update them every year. They make us do that.
Now, with that said, we're not going to update the Facebook example because it's frozen in time. So there are some examples that live on. But as far as illustrations of real world companies, we do that on quite a regular basis because it's fun. Yeah.
And at Stu Kent, we do have our authors review their courseware annually to see what needs to be updated. That doesn't mean that we make major improvements each year, but we do look at that and make necessary adjustments to keep it fresh and to keep it current, because that's something that we know is important for the market. And then lastly, there was questions about another webinar. We do have another webinar coming up in June about how to use projects to engage accounting students, projects and Simternships. So you can go ahead and register for that with the link. And we'll plan another one. Another was interest in, tips for teaching accounting that was alluded to at the beginning, and there was a lot of excitement and interest around that. So we'll get that planned as well, and make sure that we send that out. Are there any other questions for Jim and Kay before we sign off? I see there's some questions about cost. In that link that we shared, we'll reach out and we can set up a demo and talk through the cost. We're doing some introductory pricing with this bundle to make sure that it works for you.
Thanks to everyone for showing up.
Thanks, you guys. Thank you.
Thank you.